You can learn a lot about a person simply by asking them one simple question. What do you know about the Federal Reserve? In my experience, that one question is a good litmus test for determining whether or not you're able to have a productive conversation with that person. There are 3 avenues the response will go down. Most will answer that they know little to nothing. This is the normal response that you will get. A much smaller number of people will give you a general rundown of why it exists and what its functions are. Then there are the conspiracy theorists and libertarians. This group is the second largest. I lump these two together not to discredit libertarians, but because they both have a very negative opinion of the Fed. You can have a perfectly reasonable conversation on the topic with the libertarians, and they can have legitimate concerns when it comes to the current monetary system. As for the conspiracy theorists, however, they have their own ideas about who's actually in charge, and it's typically the Jews. It should be noted that these people assume that when you say that the Fed prints money, they think it literally prints money. They tend not to know what the Fed actually does or how it works. This lack of knowledge allows them to imagine it as serving whatever imaginary villain they happen to dream up. Since they don't know how it functions, to them, it can be anything they need it to be to serve their narrative. The United States Federal Reserve was founded in 1913, and ever since, it has been the target of many individuals and groups looking for the source of all of their problems. Humans have this nasty little habit of blaming things and people that they don't understand. When it comes to the Fed, the reality is unfortunately very boring. At its core, it's just a bank for banks. There is no secret plan to destroy the world. The lizard people aren't using it to fund their giant heat lamps that they have to get installed in their houses. And once you understand what it does, it's easy to understand why it exists. It is an institution whose actions have far-reaching consequences. It has an immense influence on everyone's life, but most have no idea how or why. When most people think of the Fed, they probably imagine a building in Washington with a bunch of pillars and the ever-present faint whirling of money printers. In reality, the Fed is a system. It isn't just a single bank. It is made up of 3 components. There's the Federal Reserve Board of Governors, the Federal Reserve Banks, of which there are 12, and the Federal Open Market Committee. The Board of Governors is a federal agency. There are 7 members who are appointed by the president with a single 14-year term, and they report directly to Congress. The president also elects the board chairman and vice chairman, who have 4-year terms. Though unlike the general board positions, they can be reelected. The 12 Federal Reserve Bank's branches are spread across the country and are the physical institutions that private banks interact with. While not being directly in charge, the governors provide guidance and oversight for those banks. Originally, the 12 banks were to operate independently from each other, setting their own discount rates. But as communication and transportation became faster and monetary policy became more complex, they became more and more unified and coordinated. This culminated in the creation of the Federal Open Market Committee in 1935. While they are more unified now than originally intended, they still function as independent entities, so they can adapt to the needs of their local districts. The Open Market Committee consists of 4 of the 12 Reserve Bank heads, which are rotated out every year, the head of the New York Reserve Bank, and the Fed governors. The committee holds a meeting 8 times a year, where the chairman announces the new federal interest rates, how they feel about the economy, and the things that they are paying close attention to in the near future. A key aspect of this system is that while the governors are selected by the president and accountable to Congress, they and the rest of the committee must be able to reach their decisions independently from political influence. The perceived independence of the Federal Reserve is paramount, as they need to be able to make decisions that could cause short-term pain with the intent of reaching long-term stability. The central banking system exists in multiple countries. How the market views those central banks is tied directly to the trustworthiness of the countries in which they reside. While the average citizen may not know the true impact that the Federal Reserve has on their lives, it is an institution that was established to protect their prosperity and safeguard their future. The purpose of the Fed is to keep inflation in check, keep unemployment at a manageable rate, ensure the safety and stability of the financial system, and to act as the lender of last resort. Through its normal operations to control the amount of liquidity or the ability to get cash on hand that banks have, it purchases securities that accrue interest. The Federal Reserve isn't funded by Congress. It is responsible for its own funding, and after the cost of its operations are reached, all potential profits are handed over to the U.S. Treasury. So it is in essence a nonprofit bank. In the event that it doesn't produce a profit in any given year, it borrows against its future assets. When someone makes a deposit into a bank, they take the money you deposit, leave a percentage of it in the bank, and then loan out the rest for houses, businesses, and personal loans. This is how banks are able to fund their operations, pay employees, and make profits for the owners. Without this component, banks could not function. Historically, when everything is going well, this is completely fine. A bank works out how much it should keep on hand to keep running day to day, adds a little extra as a reserve in case of an emergency, and then puts the rest to use. That is also why you get interest in your savings accounts. It's the bank paying you back for the access to your money. The issue with this before 1913 is that there was an inherent risk that a bank could run out of cash on hand. The Fed changed this, as it became a place that banks could turn to in an emergency to get more cash quickly. In modern times, the Fed heavily influences what percentage of account funds need to be on hand. This allows them to control the maximum amount of risk that banks are able to take on by adjusting the cash on hand, which acts as insulation in emergencies. A bank run is one such emergency. It is when too many people ask for their money all at once. Because banks don't actually have all of the cash on hand, if too many people try to withdraw, they can run out. Once word spreads that people are lining up to withdraw money, panic ensues, and more people rush to take out money. This can result in bank closures, account holders losing their money, and a loss of trust in the banking system as a whole. The Federal Reserve protects against the threat of bank runs, as it provides banks with a place to quickly access emergency money. The issue with banks isn't that the money in the accounts is gone, it's that it's tied up in something like a bond or a mortgage. These things are theoretically worth more than what they cost, but only with time. So as a last resort, the Fed will buy things that banks have their money tied up in, allowing banks to cover whatever short-term emergencies may arise. The Fed will also facilitate loans between private banks. So if one is low on cash, they can take out a loan from one with a surplus to cover their temporary deficit. The form of these interbank loans can vary. They can be cash for cash, like the loans that you or I would take out, a repo purchase agreement, where they sell a security with a condition that they are allowed to buy it back at a fixed price later, or they can borrow against their securities. In this last instance, the bank providing the loan acts like a pawn shop. They offer cash, and the bank taking out the loan puts up their securities like a stock, bond, or mortgage-backed security as collateral. They maintain ownership, but if they fail to pay what they have borrowed, ownership is transferred. The duration of these loans is normally very short. They are typically overnight loans and repayments. If all else fails, and no other banks can offer loans, the Fed itself steps in and provides them. Banks don't like to signal stress, so they try to acquire cash through loans with other banks if possible instead. If banks are at the point where they need to access Fed loans, that is a signal that something abnormal is happening. But that instance is exactly what the Fed is there to safeguard for. The primary function of the Federal Reserve is to act as a bank for banks. It provides them with most of the functions that a bank does for you and me, except on a much larger scale. It allows them to earn interest for money that they store in their accounts. This rate number is called the interest on reserve balances, also known as the floor. Say the interest that a bank can earn from storing its money at the Fed is 3%. That is, in essence, free money. On any given day, for any given reason, a bank may have surplus money or require more than they have on hand. They can offer or take out loans at the Fed to other private banks. The rate that those loans are offered at are always going to be higher than the floor, because if they were lower, it would make more sense just to store the money in an account earning the floor rate with effectively no risk. The floor interest rate also has an indirect relationship to the level of inherent risk of bank loans. The higher the floor rate, the higher they must charge for interest on their loans. When interest rises, you decrease the pool of people trying to acquire loans, meaning that the chances of approving loans to irresponsible people lowers, but you simultaneously increase the chance for loan defaults as the month-to-month payments become higher. As for the interest rate that the Fed charges for its own last resort loans, this is called the discount rate, or the ceiling. Banks would only set their interbank loan rate higher than the discount rate in very rare circumstances. There is a stigma with actually having to use the Fed's discount rate, so there's a small chance that a bank would rather take a higher rate just to avoid being seen as having to use the Fed itself. So the rates that banks give each other is almost always going to exist in the corridor between the interest on reserve balance, or the floor, and the discount rate, or the ceiling. The interbank loan rates don't directly translate to the everyday person. The floor rate will become the absolute minimum rate that anyone could get from a bank, but the chances of getting that loan rate are very, very small. What they do is effectively determine the amount banks need to pay to fund the loans that they give us, and what they pay determines the rate that we get for our mortgages, auto loans, credit cards, and personal loans. The reason the Fed is considered a lender of last resort is that if a bank needs to access the discount rate, it means that for whatever reason, it can't access lower private rate loans. If the Fed didn't exist, then banks in that position would be at a high risk of insolvency. But the Fed protects them in periods of extreme stress by being a place that they can turn to that will always have money to loan out, even if it is at a much higher rate. So the Fed is a safeguard against extreme stress, and they indirectly determine how good your loan rates are. If you pay even tangential attention to news about the Fed, the number you'll be hearing most about is the federal funds rate, or the FFR. This is the number that everyone tunes into those meetings every 6 to 8 weeks to hear about. That rate isn't a hard number, however. It's just guidance on what banks can expect their private interbank loan rates will be. They may be slightly higher or lower, but they will be close. The Fed prefers to guide rather than dictate. It doesn't tell banks what their private loan rates should be. It provides a window that they can operate in and allows them the freedom to come up with their own terms. As it isn't a hard number, and the Fed doesn't dictate what loan rates between banks should be, to actually change the FFR, they have to pull related levers. Typically, this means adjusting the floor rate, but other mechanisms can affect it as well. Adjusting the ceiling rate will affect the FFR, but the floor is more strongly correlated. Our entire financial system is built upon risk management. Given the same payment schedule, the higher loan rates are, the higher the payments, and the higher the payments, the higher the chance that a borrower will default. The Fed itself is seen as having as near zero risk as is possible. Banks loaning to other banks is slightly more, and loaning to the public for cars, houses, or businesses significantly more. If the Fed lowers interest rates, it means borrowing money becomes cheaper, so banks can expect to get more loan requests. Businesses will be more likely to take out loans to fund new projects and expand, and this will theoretically decrease the unemployment rate, as the new economic activity would necessitate new hiring. If interest rates are at zero, like they were during COVID, it would mean that banks are getting nothing for storing their money at the Fed, or even potentially getting charged for the privilege. This means that they would be highly incentivized to get their money in the hands of the public, because they could at least make some sort of rate off of those loans. Each rate has only a finite amount of loans that can be given out that have a negligible chance of default. No one knows what that number is, and the lower the rate, the wider that pool of safe loans becomes. The incentives caused by extremely low rates increase the likelihood loans will get approved, and to a degree, increased approvals are expected. Historically, however, banks have a tendency to get drunk off of low rates, and there are numerous instances where they have signed off on dangerous amounts of irresponsible loans. As a very intelligent man once said, "Show me the incentive, and I'll show you the outcome." At the very least, low rates mean lower payments, so people are on average more likely to make them. In a healthy economy, when loans become cheaper, they attract new economic activity. The downside is that all of that new economic activity has a high chance of increasing inflation. Increased economic activity means increased demand, and increased demand means increased price. If the Fed feels like inflation is too high, they will raise the FFR. This will slow economic expansion. Prices might not necessarily come down, but they tend to at least stop increasing. Job hirings tend to slow, and like with inflation, it doesn't necessarily mean people will lose jobs, but there will be less hiring. This balancing act is the dual mandate of the Federal Reserve. They will mention it at every chance they get. Attempting to keep a balance between inflation and unemployment is always at the heart of their rate decisions. If they feel like inflation is a more pressing matter, they will raise rates, and if they feel like it's unemployment, they will lower them. It is sometimes difficult to figure out which of these two is more pressing, and if they are both an issue, they may choose to do nothing until they can figure out which one they need to prioritize. They attempt to figure out which is a more pressing concern by getting information from monthly released job reports, the Consumer Price Index, GDP growth, and business surveys. They also rely heavily on data gathered by the reserve banks, as they tend to have their finger on the pulse of their local districts. This is why having an assortment of bank heads as part of the committee that determines the new rates is so crucial. Unfortunately, it appears that in recent years, the business surveys that the Fed relies on have become less and less accurate. There is no real benefit for businesses to fill them out, and as such, less do every year. There are also the increasingly inaccurate numbers being given out by the Bureau of Labor Statistics. They have been particularly affected by the eruption of the gig economy. Gig workers have made data gathering particularly difficult. They exist in this liminal third space, slightly better off than unemployed, but a lot make below minimum wage and lack benefits, so worse off than employed. Before the expansion of gig work, you were either unemployed or employed. If you are unemployed, you are either someone so rich that you don't need to work or someone that needs help to get back into the labor market. For the most part, these people are a financial drain, and whatever your attitude towards them, the less of them the better. I think robust support and programs to funnel them back into the labor market as quickly as possible are the best solution, but there will always be those that can't work and those that abuse the system. If you are employed, you are considered a producer and can for the most part take care of yourself. Gig work has become this purgatory between the two. It stops people from being unemployed, but it also stops people from rebounding back into the labor market with jobs that have benefits. Most are able to just barely keep themselves afloat, so they don't file for unemployment, which keeps the unemployment numbers artificially low. There are some benefits to gig work, mostly in work flexibility, but the trade-off is usually lower pay and little to no benefits. Despite what it may sound like, I'm not trying to belittle gig work, just trying to point out the complication that its expansion has caused on predictions. Another complication is the modeling used by the BLS to measure job creation. If you had been paying attention at all to the job reports last year, you may have noticed the massive revisions that came out every month. Revisions are common, but the 2025 revisions were much larger than normal. Something that most likely played a role in these large revisions is their reliance on the business birth-to-death ratio model. The actual formula is a little bit more complicated, but in essence, they create a number that represents the average amount of jobs made when a new business gets created. For argument, let's say it's 3 per business. They then subtract the amount of businesses that closed that month. This number is then used in conjunction with other models to create the estimated job growth. The issue is that a large portion of the newly created businesses nowadays are from gig workers creating LLCs for just themselves. So in reality, only 1 job is being created, but the BLS is using 3 in their estimations. While I imagine the BLS and the Fed are well aware of the issues with their metrics, and the fickleness of the data doesn't necessarily mean that correct decisions can't be reached, I would just like to point out that we are at this moment dealing with a higher amount of questionable data than we have historically. Regardless of the accuracy of the data, the Fed's goal is to ensure long-term stability. To do this, they will choose short-term pain. This is seen particularly when they raise rates in an attempt to control inflation. There is a situation, however, where both inflation and unemployment increase at the same time. This is the nightmare scenario for the Fed, the dreaded stagflation. The typical response to high unemployment is to lower rates, while the typical response to high inflation is to raise them. So then what do you do when moving in either direction will cause harm? They have to triage. Whichever of the two is more of a concern is the direction that they will move. Historically, that has been inflation, so they keep rates high, which risks short-term unemployment and a possible recession. The reason for this is that controlling for inflation by keeping rates high, or even raising them, is seen as the harder and more responsible action. Lowering rates to juice the economy and lower unemployment would be the popular short-term action. The consequences of that long-term, however, could be runaway inflation. Choosing inflation over unemployment signals that they are attempting to protect the future by biting the bullet in the present. This is a prime example of why the independence of the Fed is paramount. If a country's leader was able to set the rates themselves, particularly if they had short terms and didn't care about the future of the country after they were out of power, they would almost assuredly keep rates low. The economy would flourish, unemployment would sink, and they would be seen at the time as great for the economy. 10 years later, however, when prices have skyrocketed and you have to start paying for things in the weight of your currency as opposed to the numbers on it, that perception might change. We have seen this historically. Turkey, Argentina, Venezuela, and Zimbabwe have all directly taken control of their central banks in the past. And every time there was temporary relief, yet 5 to 10 years later, there was rampant inflation and the near collapse of their monetary systems. The Fed aims for 2% inflation per year. This is inherently bad for savers. It means that every year, their money can buy 2% less stuff. But it's good for debt holders because their debt becomes cheaper every year after they acquire it. This sounds like a horrible situation, but it forces people and institutions to seek investments and places to store their money that will outpace inflation. In essence, money sitting on your counter becomes worth less every year. To combat this, people seek out places to store their money that will generate them a profit at or above the inflation rate. People start new businesses, invest in stocks, and buy bonds. This is all positive economic activity and it fuels growth. Inflation also drives spending. Because everything becomes more expensive with time, making a big purchase now will be cheaper than making it in the future. Now think of it the other way. What if we had deflation? Everything would become cheaper over time, meaning that people would be less likely to spend their money, because the longer you waited to buy something, the cheaper it would become. This would drastically slow the economy. Banks would be less likely to give out loans, businesses would struggle, and unemployment would grow. If a bank can get a decent rate of return on its money just sitting at the Fed, they would rather leave it there than loan it to the public, as they are essentially making free money and don't have to take any risk to get it. Loans aren't the only way that banks can grow their balance sheets. They also make money off of fees, buying treasuries, stocks, and they create financial tools such as mortgage-backed securities. Historically, treasuries are considered to be one of the safest investments. They are in essence bonds, which are given out by the government. A bond is a document that guarantees a set payment after a certain amount of time for cash up front. It is assumed that the government will always be able to pay its bonds, because even if they completely ran out of money, they could always print more to cover the bond payments. As such, they have low returns, typically between 1 to 3%. Stocks are more risky than bonds as they can fail. The potential return on investment, however, is much higher. Mortgage-backed securities are essentially a bunch of mortgages that are packaged together and then sold to investors or institutions. The fact that hundreds or even thousands of mortgages are all packaged together significantly softens the impact of individual defaults. If you own one mortgage and the loan holder defaults, you lose your entire investment. If you own 1,000 mortgages and one defaults, it's bad, but you can still expect to make money off your total investment. Banks will package a bunch of their mortgages together and then sell them off. This does mean that they miss out on the long-term profit, but it gives them a cash injection immediately and removes the risk of mortgages that have a potential to default off their balance sheets. The chances are low, but they're never zero. The US dollar is the global reserve currency. What that means is that the primary currency used for international transactions and debt transactions are tendered in the US dollar. This means that central banks in other countries hold US dollars so that they can deal with each other. This has similar significance to US taxes only being payable in the US dollar. You can buy all the Bitcoin you want, but the only way to pay your most important bill is to have dollars. A fundamental reason for this is that the world trusts the US government more than any other to settle its debts. This means that the demand for our treasuries are high, and the amount of interest we pay on those treasuries is low. The Fed's actions, and the perception the world has of it, directly affects the strength of the dollar, the demand for our treasuries, and the interest we pay on our debts. As mentioned before, in periods of extreme stress, the Fed itself will purchase large amounts of securities from banks that badly need cash injections. This is called quantitative easing. If you know anything about the Fed, it's most likely that it has the ability to print money. How it does this is probably a little different than you might imagine. They create the money digitally, and then they use that money to buy securities like bonds, treasuries, and mortgage-backed securities from financial institutions. This increases banks' liquidity, decreases long-term interest rates, and expands the Fed's balance sheets. Because the Fed is buying so many long-term bonds, there are less of them on the market. As they become more scarce, their price increases, and since the amount that they pay out is fixed, the yield decreases. The Fed doesn't create money for free. They can only do it to acquire assets. I must stress that the Fed isn't allowed to buy directly from the Treasury. It can't buy debt from the government itself, only from banks that have already purchased it. The reverse of quantitative easing, or QE, is quantitative tightening, or QT. This is when the Fed stops buying securities and lets the ones on its balance sheets mature, or even sells them off. This means that they are no longer acting as a safety net, which means that banks must find private buyers to liquidate their assets. This has a cooling effect on the risk banks are willing to accept, and makes them naturally want to increase their cash reserves. It also makes them more selective with the loans that they provide, as it's harder for them to get cash in an emergency. These actions also increase the supply of long-term bonds in the market, which decreases their cost and increases their yield. Historically, we have seen way more easing than tightening, even though it has a negative connotation, as it can be inflationary. But the alternative is stagnation. This is a state in which even low interest rates aren't enough to fuel growth. Low rates on their own don't create demand. You can offer someone a loan for $1,000 at 0% interest, but if no one wants the money, then it doesn't matter what the rate is. Stagnation indicates that people aren't confident about the economy. Low economic activity indicates that people are saving their money. And when people are saving their money when rates are low, that indicates serious uncertainty about the future. This is why the Fed has a pretty significant history of quantitative easing. Because even though inflation in the future is bad, it can be accounted for. Stagnation is incredibly difficult to break out of. Japan is a perfect example of this. They have had a stagnated economy for over 35 years, characterized by slow growth, deflation, and rising debts. In the 1980s, the Central Bank of Japan had instated unofficial loan quotas for their private banks. This meant that banks were approving loans that they typically wouldn't have, which increased the risk level on those new loans. Because there were so many new borrowers, housing and construction prices in the country ballooned. This caused the amount of cash requested on each of the new, more risky loans to increase. In an attempt to control all of this new inflation, in 1989, the Bank of Japan sharply increased their interbank loan rates. This drastically reduced the new loans overnight. Home buyers could no longer acquire new loans, and housing prices collapsed. The Japanese stock market was soon to follow. Banks were left with high levels of bad debt on the books, and many collapsed. The economy ground to a halt. Interest rates in Japan have been below 1.5% ever since 1994, and they are still to this day in a period of stagnation. It's pretty easy to understand why the Fed is so liberal with QE, even though it does have its drawbacks. It's not all bad, though. They are actually purchasing assets. During the 2008 recession, the Fed purchased trillions of dollars worth of securities from banks, and in 2011, they actually started making money off of them. It is important to mention that the reason the Fed exists isn't to protect bankers and banks. Functionally, it does protect them, and it stops banks from collapsing, but it doesn't do those things for the banks themselves. It increases faith in our institutions, protects us from black swan events, but most importantly, it protects us from our banks. If it stops a bank from collapsing, what it's really doing is protecting every person that has funds in that bank. It protects us all, but it must manipulate and save banks to do it. Faith in the independence of the Fed is crucial to the stability of the United States. Their job is to shepherd the economy through difficult times and focus on long-term stability. They must be able to make their own decisions and must be free to cause short-term pain to ensure broader long-term stability if required. If the general perception becomes that the Fed is being controlled by the government directly, then confidence in the United States as a safe place to invest and store money would be shaken. Low trust in the United States means less access to capital for our businesses and lower demand for our treasuries. This, in turn, increases the cost for the government to borrow money, meaning less can be accomplished, and our already high interest payments become even higher. People can't trust a central bank that is too connected to its country's leader. If they fear that the Fed won't control inflation, then they can easily see their investments eaten up by it in the future. They will find other places to invest their money. The majority of our institutions benefit from being federated. Independence helps maintain accountability, increases efficiency, and reduces the spread of corruption. So it isn't simply because it increases investments and indicates stability. It's also just good practice. We know empirically what happens when that trust gets eroded. We have historical examples of that happening, and it's ruinous. There are those out there that use their lack of knowledge as a license to believe in wild and heinous things about this institution and those that run it. Hopefully, this will be able to serve as some sort of insulation against that proclivity.